Hello, everybody, and welcome to this lecture video covering deferred taxes related to a business combination. Deferred taxes, as to serve as a reminder, arise because of differences in the accounting income and taxable income. You'll remember from your second intermediate accounting course that these differences can either be permanent in nature or they could arise due to timing differences. It is the timing differences which result in temporary taxable or deductible future differences in the tax basis and the accounting net book value. And this amount of the temporary taxable or deductible difference multiplied by the future tax rate gives us the deferred tax asset or liability. Now, in the case of a business combination, deferred taxes are calculated on acquisition date. On the date of acquisition, the tax basis and the net book value of the subsidiary's assets and liabilities could differ. And as such, the subsidiary may have a deferred tax position already on its books. However, because the acquisition cost is allocated to both book values and to fair value differences, if there's any difference between the book value and the fair value, that difference will result in an additional deferred tax asset or liability. The deferred tax position will be equal to the tax rate times the sum of the fair value differences. If the fair value differences are a net debit, then there will be a deferred tax liability. If, on the other hand, the fair value differences were a net credit, then they will result in a deferred tax asset. Should be kept in mind that we do not calculate any deferred taxes for goodwill. So deferred taxes are only calculated for fair value differences, not on goodwill. The deferred taxes calculated at the date of acquisition get amortized in every subsequent consolidation period. And the idea there is, as the fair value differences get amortized, so also should the deferred tax position pertaining to those fair value differences. Of course, changes in future tax rates can result in changes to the deferred tax position for consolidation purposes, but that is something that is a little beyond the scope of our discussion for this course. By way of an example, we're going to look at problem 9-4 from the textbook. The facts are that on January 1st, year 5, Green Inc. purchased 60% of the common shares of Mansford Corp. for $211,800. Green's balance sheet data on this date just before the acquisition were as follows. So this is the balance sheet for Green Inc. The carrying amounts as well as tax-based numbers are given to us. The balance sheet and other related data for Mansford are as follows. So here we're given the balance sheet carrying amounts, the fair values, and the tax-based information for Mansford. Additional information, as at Jan 1st, year 5, the estimated useful lives of the building and equipment were 15 years and 4 years respectively. The term to maturity was 10 years for the non-current liabilities. No goodwill impairment since the date of acquisition. What we need to do is prepare a consolidated balance sheet on Jan 1st, year 5. And we'll also need to prepare a schedule of changes in the acquisition differential from the period Jan 1st, year 5 to December 31st, year 8. Okay, so just scrolling back and taking a look at Mansford Corp, you notice the carrying amounts are for the most part equal to the fair values, but there are some exceptions. So you have inventory that has a carrying amount that is less than the fair value. Land has a carrying amount less than the fair value. Buildings have a carrying amount less than the fair value. The equipment's carrying amount is more than the fair value, and non-current liabilities have a carrying amount that is less than fair value. So we can calculate fair value differences. So there's no fair value difference as far as the cash is concerned or accounts receivable. Inventory has a fair value difference that is $7,800 more than the carrying amount. Remember, assets, understated assets is a positive. For land, the fair value difference is a positive 135,000. For buildings, the fair value difference is 3,000 positive. For equipment, the fair value difference is $1,000 negative. The reason being, carrying amount is more than the fair value. For liabilities, understated liabilities is a negative. So for the non-current liabilities, we'll have a negative $1,400 fair value difference. Now, these fair value differences will result in additional deferred tax position for this company. We'll take a look at that in a moment. First, I want to explain to you folks how the existing deferred tax liability sitting on the books of Mansford Corp has been calculated. Notice there is a deferred tax liability position of $12,040. How is that calculated? To look at that, we have to compare the tax base. So the tax base information for Mansford was given to us and the carrying amounts. And notice here I've put debits as positives, credits as negatives. So you have cash, accounts receivable, inventory, land, buildings, equipment, current liabilities and non-current liabilities for Mansford. For the liabilities, because liabilities are credits, I put them as negatives. So adding up, we get a total tax base of 174,435. As far as the carrying amounts are concerned, the total adds up to 208,835. Now you can calculate the differences. The differences are always calculated by subtracting the carrying amount from the tax base. So there's no difference for the cash or the accounts receivable or inventory or land. But for buildings, the tax basis is lower than the carrying amount. So that results in a future taxable difference of $22,200. For equipment, likewise, there's a future taxable difference of $12,200 and nothing as far as the liabilities are concerned. So these two items result in a future taxable difference of $34,400. Given the tax rate is 35%, both companies, 35% multiplied by 34,400 gives us a deferred tax liability of $12,040. That is the reason why Mansford Corp has a deferred tax liability of $12,040 on its books. Now, due to the fact that Mansford is being acquired by Green Company, we need to now look at the fair values and compare them to the tax base. So the fair value information I've copied from the information given in the problem. And that, when we look at the tax base and compare it to the fair values, we end up with total, the total future taxable difference of 177,800. With a tax rate of 35%, this means that the deferred tax liability should be $62,230. So there is a difference between what the deferred tax liability is and what the deferred tax liability should be. Okay, so this difference is basically due to the fact that For Mansford, its fair values were different from the carrying amount. Now notice what is the additional deferred tax liability needed? The additional deferred tax liability, if you notice here, has to be $50,190. So we need an extra deferred tax liability equaling $50,190. And that, if you actually go back and take a look at the total of the fair value differences, so total of the fair value differences, if I was to just add them up, the fair value differences, is 143,400 net debit. So if you calculate 35% of this, 35%, but changing the sign will give you $50,190 of extra deferred tax liability. So that's the additional deferred tax liability arising from the business combination. This piece will be important for us when we calculate goodwill. So Green Company, Green Inc. purchased 60% of Mansford for $211,800. So that's the acquisition cost of 60%. Gives us an implied value of 100% of Mansford being $353,000. $211,800 divided by 60%. Now, Mansford's net book value is the sum of its common shares and retained earnings. That's 196,795. So if we subtract the 196,795 from 353,000, we get an acquisition differential equaling 156,205. We allocate this acquisition differential to the fair value differences. We've already identified the fair value differences earlier. The total of these fair value differences is 143,400. But we also figured out that we need an extra deferred tax liability of $50,190. That additional deferred tax liability of $50,190 means that the net of the fair value differences, net after taxes for the fair value differences works out to $93,210. Subtract that from the acquisition differential and we get goodwill equaling 62,995. No deferred taxes are calculated on goodwill. All right, and finally for non-controlling interest, because the parent company's purchased 60%, the other 40% belongs to non-controlling interest. So 40% of 353,000 is 141,200. We'll use this information to prepare the consolidated balance sheet of this combined entity. The parent company is Green. Now, notice that I have prepared already the balance sheet after acquisition. So what would have happened here if you go back and take a look at the parent's own balance sheet information? The parent Green Inc. had cash of $355,300. This was before the acquisition. So if Green purchased 60% of the shares of Mansford for $211,800, its cash amount will go down by that $211,800, and there would be a new line, investment in Mansford, for the $211,800. So that is what I have here. The cash balance has gone down by $211,800, and then there is a line, a brand new line for investment in Mansford. Mansford's balance sheet information is as it should be. Now, on the date of acquisition, remember the balance sheet when we make on the date of acquisition, we are supposed to eliminate the investment in the subsidiary, and we are supposed to eliminate the subsidiary's shareholders' equity. Also, we are supposed to include the fair value differences. So there were fair value differences pertaining to inventory, land, buildings, and equipment. And we have calculated goodwill to be 62,995, so that should be included. No fair value differences as far as the current liabilities are concerned, but we need an extra deferred tax liability, 50,190, and non-current liabilities, we should add $1,400 because of the credit adjustment for that. So these will be the adjustments made. We now calculate the consolidated amounts, which is just the sum of the parent company's numbers plus the subs numbers, plus or minus whatever adjustments we have. We get a total of consolidated assets, 1,861,865. And if we compare that to the liabilities and shareholders' equity, keep in mind we have to include non-controlling interests, 141,200 into the balance sheet. We get the same total for liabilities and shareholders' equity. So this was the first answer to the first part, prepare the consolidated balance sheet. Now, what happens to the acquisition differential afterwards is that the fair value differences are amortized over time. Now, we were told in the question that as at Jan 1st, year 5, the estimated useful lives of the building and equipment were 15 years and 4 years respectively. The term to maturity for the non-current liabilities was 10 years. So you're going to use that information to prepare the amortization schedule. On the date of acquisition, the fair value differences were these items, these numbers, 143,400. We had the deferred tax liability, 50,190, goodwill, 62,995, giving us a total acquisition differential of 156,205. Now, we've been asked to prepare an amortization schedule up to the end of the year 2008. So what we're going to do is split up the amortization impairment into previous periods and the current year 2008, and then calculate the balances at the end of 2008. From Jan 1st, 2005 to December 31st, 2007 is 3 years, 2005, 6, and 7. Inventory being a current asset, the fair value difference for the inventory will have amortized within a year from the date of acquisition. Land is not depreciated, so unless the land was sold to an outside party, the fair value difference on the land will remain unamortized. The buildings had a useful life remaining of 15 years, so 3,000 divided by 15 works out to $200 each year. For the years 5, 6, and 7, that would mean amortization of $600. For the year 2008, another $200, leaving us with an unamortized balance, 3,000 minus the 6 plus 2, 800, $2,200. The equipment had 4 years on the date of acquisition, so 1,000 divided by 4 is $250 each year. Just keep in mind, don't change the sign. So it was a credit, negative basically. So the amortization for 3 years works out to 750. For year 8, another 250, nothing remaining for the equipment. For the non-current liabilities, they had 10 years to go. So negative 1,400 divided by 10 works out to negative $140 each year. 3 years, 420. For year 8, 140. Remaining unamortized, 840. You add up vertically, you get these amounts. The total amortization up to the end of the year 7 is $7,230. Amortization for year 8 is negative 190. Unamortized balance 136,360. The deferred tax liability was 35% of the fair value differences. So as the fair value differences get amortized, so also does the deferred tax liability. So up to the end of year 2007, 35% of 7,230 or 2,531. Just make sure that the sign is flipped. All right, so for this one, 190 negative, the amortization for the deferred tax liability would be 190 times negative 190 times the negative 35%. So that's $67. And the unamortized balance is negative 47,720. The negative basically implies it's a credit. Liabilities are credits. Goodwill, there's been no amortization or no impairment rather. So the total balances are, as far as the amortization is concerned, taking into account also the amortization of the deferred tax liability, total amount is 4,700. A little bit of a rounding, right? A little bit of a rounding error there. 124 credit for the year 2008, leaving us with 151,629 as the net unamortized acquisition differential at the end of 2008. Next, we'll talk about topic 10, intercompany bond holdings. Intercompany bond holdings is a very rare occurrence, especially within the same entity. However, if there are intercompany bond holdings between the parent company and the subsidiary, then it needs the following eliminations. On the consolidated income statement, we must eliminate the intercompany portion of interest, income, and interest expense. And on the consolidated balance sheet, we must eliminate the intercompany portion of the bond investment and the bond liability. Usually, this would not cause a whole lot of grief if the bonds had been issued at par. However, if the intercompany investment is made at a discount or a premium, then the elimination of the investment and the accompanying bond liability may result in a gain or a loss. This gain or loss is subsequently reversed due to interest elimination, and such elimination of the gains or losses have to be allocated between the parent company and the subsidiary using the effective interest rate method. Here's an example of intercompany bonds from your textbook, problem 7-11. We're told that Alpha Corporation owns 90% of the common shares of Beta Corp and uses the equity method to account for its investment. On Jan 1st, year 4, Alpha, the parent company, purchased $160,000 of Beta's 10% bonds for $150,064. So that's clearly they purchased the bonds at a discount. Beta's bond liability on this date consisted of $800,000 par 10% bonds due Jan 1st, year 8, and unamortized discount of $73,065. There's a discount already on the books of Beta. It means Beta too had issued the bonds at a discount. Interest payment dates are June 30th and December 31st. The effective rate of interest is 6% per 6 months, so semi-annually, on Alpha's bond investment, and 6.5% every 6 months on Beta's bond liability. So what they've done is basically calculated the effective interest rates for us. Already, these are per 6 month because the bonds have 6 monthly interest payment. Both companies have a December 31st year end, use the effective interest method to account for bonds. Alpha uses income tax allocation at a 40% tax rate when it prepares its consolidated financial statements. Beta reported a profit of $114,000 in year 4, declared a dividend of $30,000 on December 31st. Now, there's a few requirements here. Calculate the amount of the gain or loss that will appear as a separate item on the year 4 consolidated income statement as a result of the bond transaction. Talk about that in a bit. They've also asked for equity method journal entries that Alpha would record for year 4, and then calculate the amount of the bond liability that will appear on the consolidated balance sheet as at December 31st. So what I'm going to try to do is talk in general about what to do when you have an intracompany bond liability position. So pertaining to these companies here, on Jan 1st, year 4, the carrying amount of the bonds payable was 726,935, 800,000 par value minus the unamortized discount 73,065. The bonds had a carrying amount of 726,935. Now that was for $800,000. Our friend Alpha, the parent company, purchased $160,000 worth of the bonds. So 160,000, you would notice, is 20%, right? So if you calculate 20% of 726,935, the carrying amount of the intracompany bonds works out to 145,387. Alpha has purchased these bonds at a cost of 150,064. So Alpha has paid 150,064 for bonds that had a carrying amount on the books of Beta of 145,387. So a way of thinking about this transaction is that, essentially if the parent company and the subsidiary, at least from a consolidation perspective, are indistinguishable, it really does amount to a retirement of bonds, so that as far as the entity is concerned, the entity has bought back bonds, the bonds payable liability, having a carrying amount of 145,387, paid cash of 150,064. The difference is essentially a loss on retirement of bonds. That's basically what this amounts to. This intercompany investment essentially ends up being an effective retirement of the bonds as far as outside creditors are concerned. So this loss of $4,677 will need to be accounted for. And that amount of the loss, $4,677, will be reported on the consolidated income statement for year 4 for purposes of the bonds. Now, because these bonds are not actually retired, then for consolidation purposes, what we have to do is we have to eliminate the bond investment and the intracompany bond liability. We must eliminate the interest income and the intracompany interest expense and split the resulting gain or loss between the parent company, Alpha, and the subsidiary, Beta. And what we do is we pretend that the intercompany portion is retired at face value. So if that were to happen, from the perspective of Alpha, Alpha had made an investment in bonds, $150,064. If we pretend that Alpha got the face value of the bonds, $160,000, then from Alpha's point of view, that means a gain of $9,936. Now, with regards to Beta, Beta had a bond liability with a face value of 145,387. Why did I put that as a negative? Because that's a liability credit. If we pretend that Beta retired the bonds at face value, well, then Beta would have paid $160,000 to buy them back. And that would have meant an effective loss of $14,613 for Beta. Now, yes, overall, as far as the entity is concerned, when we eliminate the investment and the liability, there is a loss of $4,677. Well, there's a net, this 4,677 is the difference between the debits and the credits, and that is what we recorded as the loss, 4677. Now, this 4677 is considered realized in the year of the intracompany investment. But then in subsequent years, what happens is that the amount of the gain or loss is allocated to the two companies alpha and beta, as interest elimination gain or loss. To calculate those amounts, we have to make effective interest amortization schedule. So as far as Alpha Company is concerned, Alpha Company has an investment in beta bonds on which the effective rate is 6% for every 6 months. So starting with $150,064, every 6 months, Alpha is going to record, well, Alpha will say, well, they're going to get cash of 8,000. Interest is calculated at 6%. 6% of 150,064 is $9,004. So 8,000 minus the $9,004 gives us negative amortization of 1,004. And that makes sense because this balance of 150,000 needs to go up all the way to 160,000 by the end of 2007. So at the end of June 30th, to year 4, you get 150,064 minus a negative 1,004. When you minus a minus, you end up adding. So we'll add $1,004 to get 151,068. Similarly, the next round will have slightly more interest, resulting in a slightly higher negative amortization, resulting in a balance of 152,132. Over the years, the bonds will effectively be amortized. The discount will be amortized over the period 2004, year 4 through year 7. Similarly, for the liabilities, the bond payable liability, we start with a balance of 726,935. The effective rate for bonds liability for beta is 6.5%. Using 6.5%, every 6 months, beta will be paying interest on the bonds, $40,000. The interest expense will be calculated at 6.5%. So 6.5% works out to 47,251 on June 30th, year 4. We get a negative amortization of 7,251, resulting in the bond balance increase to 734,186. Over the years, the bond liability gets amortized to $800,000, the face value of the bonds. Now keep in mind the intercompany portion is 20%. So as of Jan 1st, year 4, the intercompany portion was 20% of 726,935. In subsequent years, this intercompany portion of the liability of the bond liability will also go up, creep up, all the way up to 160,000. Just as the bond investment goes up to 160,000, similarly, the intercompany portion of the bond liability will increase to 160,000. Now, what happens is each year, so for example, the first year, as far as alpha is concerned, at the end of year 4, the investment will have a balance of 152,132 compared to $150,064. So if you think about the gain that we had calculated on Jan 1st, year 4, the gain was basically us pretending that the investment of $150,064 was retired at face value of 160,000, and that difference resulted in the gain. But as the investment account value changes due to the effective interest amortization, there is going to be a shrinkage in the gap between the face value of the bonds and the carrying amount. This shrinkage is basically for year 1, the amount by which the discount shrinks is 152,132, the investment balance at the end of year 4. and the investment balance at the beginning of year four, 150,060. So this shrinkage is seen as an interest elimination loss. So because of the interest elimination, right, there is going to be a loss allocated to alpha. As far as beta is concerned, in a similar vein, the intercompany liability had a carrying amount of 145,387 on Jan 1st, year four. At the end of year four, though, that liability has increased to 148,382. So this is basically due to the interest calculated on June 30th and December 31st. So the result of this being that the gap between the carrying amount of the intercompany liability and the face value. Recall that the initial amount of the loss allocated to beta was due to the difference between the face value of the liability, 160,000, and the carrying amount. So as the carrying amount increases, the gap between the face value and the carrying amount narrows. So as that narrows, the loss attributable to beta shrinks, and that means there is a gain. As far as beta is concerned, there's a gain arising from interest elimination in the amount of, because you're eliminating the interest, right? So that's the important bit to remember. Due to the elimination of the interest on the liability, there's going to be a gain of 148,382 minus the 145,387, or $2,995. For the entire entity, you have a loss of 2,068, a gain of 2,995. For the entire entity, there is a gain of $927. So this process is continued every year until the end of year seven. And you'll find that over the 4 years, the total amount of the interest elimination loss for alpha is $9,936, which notice corresponds nicely to the gain that we recorded on the account of the intercompany investment. So initially, we allocate a gain amount of 9,936 to alpha, but that gain amount reverses due to interest elimination losses over the 4 years. And initially, we had allocated a loss of 14,613 to beta, and that loss gets reversed over the 4 years in the form of interest elimination gain. Overall, the impact is that a loss to the entity that's recorded on Jan 1st, year four of 4,677 is wiped out in the form of interest elimination gains for the years 4 through 7. Now, on subsequent balance sheets, the intercompany portion of the bond liability is eliminated, as is the investment in the bonds. The amount of bond liability that will be reported in subsequent years, this is the answer to part C, what amount will be reported. So the carrying amount on December 31st, year four, you can see here is 748,908. So 741,908. The intercompany amount is 148,382. You will eliminate the 148,382 to get the net amount to be reported on the consolidated balance sheet for the bonds payable, 593,523. At the end of year five, you will have 758,891 minus the intercompany portion, 151,778. At the end of year six, you will have 778,153 minus the 155,631 to get 622,522. And at the end of year 7, basically, we're going to have 800,000 minus the 160,000, or a net amount of 640,000. The bonds have a maturity date on Jan 1st, year 8. Okay, so we have answered part A, we have answered part C. Now, the answer to part B is the equity method journal entries. Well, in order to record the equity method journal entries, we need to calculate the equity method income. So we have, as far as the bonds are concerned, there is the downstream portion, which is related to alpha, and there's the upstream portion, which is related to beta. For year 4, alpha has a gain of $9,936 due to the elimination of the bond investment. And there is an interest elimination loss for year 4, 2,068. So the net adjustment that alpha has to make is $7,868. Given a tax rate of 40%, the tax amount on 7,868 is 3,147, leaving us with $4,721 as being the net downstream bonds adjustment. For the upstream, beta is initially allocated a loss of $14,613, which is partially reversed in the form of an interest elimination gain, $2,995. The net amount of the adjustment is $11,618 before taxes. Taking a tax rate of 40%, we get an after-tax adjustment of $6,971. So when calculating the investment income, we'll start with beta's equity method income, or beta's net income rather, for year 4 is 114,000 according to the problem. Beta reported a profit of 114,000 in year 4. This is before making any kind of adjustments for the bonds. So we have to take the upstream bond adjustment. So because this is a loss, we will reduce the income by 6,971. So after making the adjustment for the bonds, we get 107,029, which is beta's adjusted net income for year 4. And alpha's share, alpha owns 90%. So alpha is going to pick up 90% of 107,029, which is 96,326. Now this 96,326 is before making an adjustment for the downstream portion of the bonds. The downstream portion is a gain of 4,721. So add 4,721 to 96,326, we get a total investment income from beta under the equity method, 101,047. Keep in mind that this is a parent-subsidiary relationship. So whereas the upstream adjustments are made to the parent's share, any downstream adjustment must be made 100%. Okay, do not prorate for the parent's share for the downstream adjustments. Journal entries. To record the investment income, you want to debit the investment account and credit investment income, 101,047. And because the subsidiary had declared a dividend of 30,000 on December 31st, you want to debit dividends receivable, because if the dividend has been declared, you don't want to debit cash. Debit dividends receivable, 90% of 30,000, 27,000, and credit the investment in Beta Corp, $27,000. We will now talk about joint operations. Recall, joint arrangements were covered under IFRS 11. A joint arrangement has the following characteristics. The parties are bound by a contractual arrangement, and the contractual arrangement gives two or more of these parties joint control of the arrangement. There are two broad classifications of joint arrangements: joint operations and joint ventures, which we have covered earlier in topic 5. Joint operations are essentially joint arrangements whereby the parties that have joint control over the arrangement have rights to the assets and obligations for the liabilities relating to the arrangement. These parties are called joint operators. Now, how is the accounting done for a joint operation? A joint operator shall recognize, in relation to its interest in a joint operation, its assets, including its share of any assets held jointly, its liabilities, including its share of any liabilities incurred jointly, its revenue from the sale of its share of the output arising from the joint operation, its share of the revenue from the sale of the output by the joint operation, and its expenses, including its share of any expenses incurred jointly. So the bottom line is that when you account for a joint operation, you end up performing what's called a proportionate consolidation. Intercompany transactions, if there are sale of assets, the joint operator must not recognize its share of gains or losses resulting from the purchase or sale of an asset to the joint operation. This is similar to what we had done for joint ventures as well. The portion of the gain or loss related to the other joint operators may be recognized immediately. That is similar to how we had dealt with this matter for joint ventures as well. And the joint operator's share of the gain or loss is recognized if the asset is resold to a third party. So this is one distinction, that whereas for the the joint venture, there was a recognition of the gain or loss with passage of time. This one, we hold back until the asset is resold to a third party. So how do we classify a joint arrangement? How do we decide whether a joint arrangement is a joint venture or a joint operation? We first look at the structure of the joint arrangement. Is the venture structured through a separate vehicle, through a separate company or not? So if it's not structured through a separate vehicle, then we have one conclusion. If it's not, or if it is structured through a separate vehicle, we have a different conclusion. So if, firstly, the joint arrangement is not set up as a separate company, then it's a joint operation. Now, if on the other hand, if the joint arrangement is structured as a separate company, set up as a separate company, it doesn't still automatically mean that it's a joint venture. You have to ask the following questions. You should look at the legal form of the separate vehicle. You should look at the terms of the contractual arrangement, and wherever relevant, other factors and circumstances. If any of those additional considerations indicate it's a joint venture, then it should be accounted for as a joint venture. If not, then we account for it as a joint operation. Taking a closer look at classifying a joint venture arrangement that is structured through a separate vehicle. Keep in mind, we are looking at answers to 3 questions. If the answer is yes, then we would classify the joint arrangement as a joint operation. If the answer is no, we would classify it as a joint venture. So the first thing to look at is the legal form of the separate vehicle. So the question to ask is, does the legal form of the separate vehicle give the parties rights to the assets and obligations for the liabilities relating from the arrangement? So you may remember from earlier accounting class, the accounting for partnerships, where we have partnerships, the partners have rights to the assets and the liabilities, right? So that legal form, the legal form of a partnership, would indicate a joint operation. If, on the other hand, the legal form was that of a company, where the each of the parties only gets a share of the net assets, i.e., the shareholders' equity, and not the assets and liabilities per se, well, in that case, we would call that a joint venture. Another thing to ask is, what are the terms of the contractual arrangement? Do the terms of the contractual arrangement specify that the parties have rights to the assets and obligations for the liabilities relating to the arrangement? So again, remember, in a partnership, partners are liable for the liabilities, right? And they have rights to the assets. If the answer is yes, it's a joint operation. If no, then the third question to look at is other facts and circumstances. Have the parties designed the arrangement so that its activities primarily aim to provide the parties with an output, and it depends on the parties on the continuing basis for setting the liabilities relating to the activity conducted through the arrangement? So, i.e., do the parties have rights to substantially all of the economic benefits of the assets held in the separate vehicle? If the answer to these questions is yes, then it's a joint operation. If not, then it's a joint venture. So if we were to compare joint operations versus joint ventures closely, you want to take a look at the terms of the contractual arrangement. So if the contractual arrangement provides the parties with rights to the assets and obligations for the liabilities, it's a joint operation. On the other hand, if the arrangement provides the parties with rights to the net assets, i.e., shareholders' equity, then it's a joint venture. If the parties share all interests in the assets in a specified proportion, then it's a joint operation. If the parties have no interest, i.e., rights, title, or ownership in the assets, then it's a joint venture. As far as obligations go, if the parties share all liabilities, obligations, costs, and expenses in a specified proportion, and the parties are liable for claims raised by third parties, then it's a joint operation. Whereas if, on the other hand, the joint arrangement is liable for its debts and obligations, not the parties owning it, the parties are only liable to the extent of their respective investments, and the creditors don't have any rights of recourse against either owner, well, then it would be a joint venture. Thirdly, with regards to revenues, expenses, profits, or losses, if these are allocated amongst the parties, then it's a joint operation. In a joint venture, the owners have a share of the net profit or loss, not revenues and expenses. As far as guarantees are concerned, this can be a common trait between joint operations and joint ventures, because in most cases, the owners have to extend guarantees to third parties. So just the mere fact that one of the owners has to extend a guarantee to a third party creditor is not a definitive indicator of whether the arrangement is a joint arrangement or a joint operation or a joint venture. Here's an example from the textbook, problem 9-6. So We're told that on Jan 1st, year 6, HD Limited, a building supply company, JC Limited, a construction company, and Mr. Saeed, a private investor, signed an agreement to carry out a joint operation under the following terms and conditions. A partnership under the name of Olympic Homes will be established. JC will identify the homes for renovation. Olympic Homes will purchase the home, arrange a first mortgage on the property when the home is purchased for renovation and resale. JC will perform the renovation work at a discounted fee. HD will supply all of the construction materials at a reduced markup from its regular sales. Mr. Saeed would guarantee the payment of the mortgage and will lend money to Olympic for the down payment of the purchase of the property and to finance the cost of materials and labor during renovation. The loans will be interest-free with no monthly payments, will be repayable out of the proceeds on sale of the property. All three parties will contribute $100,000 as startup capital, will have a 1/3 interest in the assets, be responsible for 1/3 of the liabilities, and will receive 1/3 of the profit of the partnership. All three parties must agree on major operating and financing decisions with respect to operations carried out by Olympic. So some important points that we should note here. Clearly, we can see there's definitely joint control. This is not structured as a separate company, but rather as a partnership. The operators are sharing control. The operators are to get 1/3 shares of assets, liabilities, as well as profits. Okay, so this is basically a joint operation, and it must be accounted for as a proportional consolidation. So each party will use proportionate consolidation to account for its own share in the partnership. Next, we were given condensed financial statements for HD and Olympic. HD is one of the joint operators, and Olympic is the joint operation. So there's information given here, the balance sheet information given, and income statement information given. Notice that Olympic is not taxed because it's a partnership. The burden of the tax is passed on to the partner. In year 6, HD had sales of $102,000 to JC at a markup of 20% of selling price. That's an intercompany sale. At December 31st, year 6, the property under renovation included supplies purchased from HD of $30,000. Olympic completed 2 projects under the joint operations. It distributed $40,000 of income to each of the partners in December. And that's the reason why in the income statement of HD, we have $40,000 as income from Olympic sitting. HD accounts for its share of income from joint operations when it is received from Olympic, and that's what seems to have happened. Debit cash, credit income from Olympic, but that's not how the accounting should have occurred. HD pays income tax at a rate of 40%. The income earned by Olympic is not taxed in Olympic. It is flowed through and taxed in the hands of the partners. So whatever is the income ultimately pertaining to Olympic, HD will be responsible for paying 40% tax on it. We are required to prepare year 6 financial statements for HD in accordance with IFRS 11. Now, in accordance with IFRS 11, this being a joint operation, we have to use proportionate consolidation. Okay, so I'm just going to demonstrate the solution to you folks here. Steps 1 through 3 are not applicable. Steps 1 through 3, remember, step 1 was identify the acquirer. Well, there's no acquirer here because it's a joint operation. There's no acquisition differential or amortization of acquisition differential because there was no acquisition as such. This was a joint operation that was formed by HD. So the steps 2 and 3 are not applicable. Step 4 is the intercompany sales. So there had been sales, intercompany, HD had sales of $102,000 to JC. So HD will only eliminate its share. 1/3 of the 102,000 will get eliminated. 34,000 are to be eliminated when making the income statement, will be eliminated from sales and cost of goods sold. Step 5, there are no intercompany amounts receivable or payable, so it's not applicable. Step 6, there is intercompany profit in the supplies, the $30,000 of the supply, the property under renovation included supplies purchased from HD of $30,000, on which there was a markup of 20%. 20% of 30,000 gives a total profit of $6,000 before tax. HD is only going to adjust for its share. Proportionate consolidation is you pick up your share only. So 1/3 of the $6,000 profit, $2,000 before taxes. Tax of 40% is $800. After taxes, $1,200. So that needs to be adjusted as far as step 6 is concerned. We are not going to calculate consolidated net income as such because we're not preparing consolidated statements. There's no consolidated retained earnings needed, again, because we're not making consolidated statements. And under proportionate consolidation, there is no concept of non-controlling interest. So steps 7 through 9 are not applicable as well. Finally, making the income statement. So we have, as far as HD is concerned, we have the income statement information for HD that we can copy from the problem. So HD has its own standalone profit of $124,000. Next, HD is going to pick up its share, i.e. 1/3 of the amounts pertaining to Olympic. So HD's share of Olympic will be whatever numbers are given for Olympic here, we'll pick up 1/3 of that. So 1/3 of HD's share of Olympic's numbers. But these are subject to adjustment. So what are the adjustments? We have to eliminate from sales and cost of goods sold $34,000 of the intercompany sales portion. Next, the income that has been recorded by HD as income from Olympic, we need to get rid of that because that's not really the income, because HD is going to calculate its own share of income from Olympic. Now notice that I have, as far as Olympic was concerned, Olympic did not have any income tax expense. But when we pick up HD's share of Olympic, because HD is going to be responsible for income taxes, we calculate tax at the rate of 40% on HD's share of Olympic's net income, right? Or income before tax. All right, so we calculate additional tax of $21,200. And then for step 6, the $2,000 of the ending inventory profit, we need to eliminate. Remember, we need to adjust for that. So this profit, when we eliminate, because it's unrealized, we will add back $2,000 to cost of goods sold. The tax amount of $800 we will subtract from income tax expense. So after this, if we were to calculate the totals, the total sales, HD's sales plus HD's share of Olympic's sales minus the intercompany portion, you get $2,046,000. The income from Olympic is wiped out, so we get total revenues of $2,046,000. The cost of goods sold adds up to $1,384,000. The rest of the expenses, they don't have any adjustments as such. You get $1,831,000. The income before tax is $215,000. The adjusted income tax expense works out to $100,400, and the adjusted profit is 114,600 in total for HD. As far as the balance sheet is concerned, again, we take the separate company balance sheet for HD and 1/3 of Olympic's balance sheet, because HD will pick up 1/3 of all the assets and liabilities pertaining to Olympic. So HD's own balance sheet plus HD's share of Olympic's balance sheet. Now to this, we're going to make some adjustments. Firstly, the investment in Olympic Homes needs to go. So get rid of the intercompany investment and get rid of the capital invested as well, because that is Olympic's shareholders' equity. You want to get rid of that. Then you have to consider the fact that there is an unrealized ending inventory profit of $2,000. So that has to be adjusted. So you will take out the inventory amount. So take out the inventory amount, 2,000, and add deferred tax asset of $800. The net of these two amounts, $1,200, we have to adjust against retained earnings. We adjust against retained earnings. So if we were to now go ahead and calculate the total amounts, we get properties under renovation. Oh, sorry, so this 2,000 should come out of properties under renovation. My bad, properties under renovation. And the deferred tax asset would be $800 from there, because the 2,000, so this recall is included, the property under renovation included supplies purchase. So that is why we make the adjustment to the properties under renovation. The rest of the assets, not really any change there. We end up getting a total of assets, $2,033,800. $1,200, remember I was mentioning, is the net adjustment for the unrealized profit. That is an additional adjustment to retained earnings, because we did not calculate retained earnings separately. And so in total, we have total liabilities and shareholders' equity, $2,033,800, which agrees with the total of the assets. Next, take a look at topic 11, segment disclosures. Operating segments. So the definition of an operating segment, it's a component of an entity that engages in business activities from which it may earn revenues and incur expenses, whose operating results are regularly reviewed by the entity's chief operating decision maker, and for which discrete, i.e. separate financial information is available. IFRS 8 then describes reportable segments, and it says an entity shall report separately information about an operating segment that meets any of the following quantitative thresholds. A, its reported revenue, including both sales to external customers and inter-segment sales or transfers, is 10% or more of the combined revenue, internal and external, of all operating segments. The absolute amount of its reported profit or loss is 10% or more of the greater in absolute amount of the combined reported profit of all operating segments that did not report a loss, and the combined reported loss of all operating segments that reported a loss. And C, its assets are 10% or more of the combined assets of all operating segments. So there are three tests that we apply. Any segment that meets any of these tax thresholds must be reported separately. Additional reportable segments are also described under IFRS 8. Paragraph 13 says, management can provide separate disclosures for operating segments that do not meet these quantitative thresholds if management believes the information will be useful to the financial statement users. And there is an overarching requirement under paragraph 15 that at least 75% of the entity's total revenue has to be separately reported. And if 75% is not reported under the identified segments, then additional segments have to be identified. What kinds of disclosures are needed? Well, those are described under IFRS 8. Primarily, these disclosures relate to what factors are used by management to identify the segments, a measure of profit, revenue, and assets for each of the reportable segments, specific amounts that are included in the measure of profit or loss, for example, operating income, net income, etc., that is regularly reviewed by the chief decision maker. Reconciliations of the segment's total revenues, profits, assets, liabilities to the entity's overall revenues, profits, assets, and liabilities. And then finally, revenues segregated by product or service and by geographical area. Looking at an example, Unilever PLC is a multinational corporation. It's a European company. From its balance sheet, we get this information pertaining to the segments. The Unilever has basically three broad areas: beauty and personal care, foods and refreshment, and home care. It identifies these segments as part of these specific categories, rather, product categories within those segments. And they've given information pertaining to the relevant contributions to the group revenue. For example, fabric care accounted for about 15% of 2019 revenue, ice creams brought in 13%, so on and so forth. And notice they have a separate category called other, which basically, these are basically categories that did not meet their own internally defined threshold of 5% or more of their revenue. And then Unilever also provided additional information by geography. So here's information about turnover, operating profit, etc. Asia, Middle East, the Americas, Europe, and the total. An example from Canada is for TELUS. So TELUS has basically two broad segments, the wireless segment and the wireline segment. Look at Canadian Tire. Canadian Tire has three segments: retail, financial services, and the real estate investment trust, the REIT segment. And it provided, in its balance sheet, it provides details about each of these segments: the retail segment, the financial services segment, and the real estate investment segment. Looking at an example from the textbook, problem 9-7, you're given information about Casbar Corp for year 5. Casbar has 6 operating segments, A, B, C, D, E, F. You're given numbers about revenues, profit losses, and assets. And you're asked to determine which operating segments need separate disclosure. So what I've done here is reproduce the information pertaining to the revenues. So copy the revenues, split the profit numbers from the losses. So the profitable segments and the loss-making segments. And notice that I removed the sign. I'm taking the absolute values here. So I did not put a negative before the losses. And likewise for the assets. Calculate the total. So total revenues, 39,300. Total of the profit-making segments, the profit, 7,250. Total of the losses, 1,710. Total of the assets, 81,000. Now the threshold for the revenues test is 10% of total revenues. So 10% of total revenues, 39,300, 10% of that is 3,930. So if you take a look at each of these segments, you might want to identify which segments has revenues of 3,930 or more. So it should be a pretty easy exercise here. A, B, and C, and E are four segments that had revenues of 3,930 or more. So based on the revenues test, the reportable segments include A, B, C, and E. And since only one test is good enough, you're certainly going to report A, B, C, and E. If you were to apply the profit and loss test, and you should go through each of the three tests, if you were to apply the profit and loss test, you want to first look at whether the total of the profits is greater or whether it's the total of absolute value of the losses. When you look at the absolute values, the total of the profits is the bigger number. So 10% of the larger of the absolute value of profits and losses. So 10% of 7,250, we get a threshold of 725. So this 725 is to be applied on all of these segments. Doesn't matter if it's a profitable segment or a loss-making segment, as long as the absolute value without any attention to the signage is more than 725, that segment will be separately reported. So what do we get? We get A, B, C, and E once more. So based on the profit and loss test, it's A, B, C, and E again. Finally, if you take a look at the assets, the total of the assets is 81,000. Our threshold is 10% of the total assets. That's 8,100. So if you apply 8,100 as our test, then we find it's A, B, C, D, and E that will be separately reported. So based on the three tests, remember, any one of the tests, if it's met, is good enough. Looking at all the three tests in conjunction, the reportable segments include A, B, C, D, and E. What does that leave us with? It only leaves F. So because F is the only segment remaining, rather than calling it other, I think it makes sense that Casbar should report segment F's numbers as well, because they have to provide a reconciliation to the totals anyways. So if they are going to report separate information for segments A, B, C, D, and E, and they have to provide a total for a total column for the company, they will end up reporting segment F as well. So the correct answer here is that the reportable segments include A, B, C, D, E, and F. And F is being reported here because it is the only one remaining. Had there been one more segment that did not meet the test, then we could have clubbed together, we could have added together, say F and G. There was another segment G that did not meet any of the tests. We could have added F and G together and called them other. Another example, this one from the lesson notes, is example 11.2. You're given information for 6 segments here: alpha, beta, gamma, delta, theta, and eta. And once again, if we were to look at the revenues, separate the profits and losses, and add up the assets, we would get our threshold for the revenues will be 10% of 26,700, or 2670. The greater of total profits or total losses is 3725. So that'll give us a threshold of 372.5 for the profits and losses. And for the assets, it's 10% of the total assets, 5,000. So if we were to apply the revenues test here, 2670 is what we are looking for. So we get alpha, beta, and gamma meeting the revenues test. Applying the profits test, the profit or loss, greater of the two, 10% of the greater of the two, 372.5, again, we get alpha, beta, and gamma. And then if we look at the assets, one more time, it is alpha, beta, and gamma. So here, interestingly, you have 3 segments that have not been identified. So just going by the quantitative thresholds, we get alpha, beta, and gamma are the reportable segments. Now, keep in mind, there is an overarching paragraph 15 from IFRS 8 told us that we have to make sure that at least 75% of the combined revenue, all right? At least 75% of the combined revenue is separately reported. So we want to check whether that's indeed the case. So based on the 3 tests, the reportable segments are alpha, beta, and gamma. Now, if you take a look at what their revenues add up to, alpha has revenues of 7,500, beta has revenues of 7,600, gamma has revenues of 4,500, which gives us 19,600. Now, if we calculate 19,600 divided by 26,700, we actually only have 73.41% of the total. This means our overarching requirement of 75% of total revenues being separately reported is not met right now. So given this, we have to identify more segments. Which segment? Well, it would depend on management's opinion on which additional segment will provide more useful information. Could be delta, it could be theta, it could be eta. As long as the total surpasses 75% of the total revenue, the total of the reportable segments surpasses 75% of the total revenue, we will be okay as far as IFRS 8 is concerned. Finally, we have topic 12, indirect control. It is possible for a company to control more than 50% of the votes of another company without actually owning all of those shares. And this can happen when a company has indirect shareholdings. When a company has indirect control over other companies, it must consolidate the financial statements of those companies. The consolidated net income attributable to the parent will depend on the percentage of the parent's direct or indirect ownership. The rest is attributable to non-controlling interests. So here's an example. You can see that company A clearly has control over both companies B and C, owns 80% of company B, 70% of company C. Also, given that company B owns 60% of company D and company A controls B, company A has indirect control over company D because D is a subsidiary of B, B is itself a subsidiary of A. What may not be apparent is when you look at company E, company A controls company C. Company C owns 30% of the common shares of company E. So company A can tell company C how to vote as far as its 30% ownership in company E is concerned. Similarly, because company A controls B, B controls D, and D owns 75% of the shares of company E, company A can tell B to tell D how to vote with the 45% of the shares. So indirectly, without owning a single share of E, company A is able to control 75% of the voting shares of company E. That gives company A indirect control over company E as well. Right? And that's because company A has control over 75% of the voting shares because of its control over companies C and D. So when calculating consolidated net income attributable to the parent company A, we will allocate 100% of company A's adjusted net income, 80% of company B's adjusted net income, 70% of company C's adjusted net income. And since company A owns 80% of company B, which in turn owns 60% of company D, A will pick up 80% times 60%, 48% of company D's net income. And going this way, A will pick up 70% of 30% and 48% of 45%. So that is 42.6% of company E's adjusted net income. Here's an example from the textbook, problem 8-11. So we're given information about an affiliated group during the year ended December 31st, year 2. We're told that York Limited owns 90% of Queen's Company and 80% of McGill Company. Queen's owns 70% of Carlton, 10% of McGill, and McGill owns 60% of Trent. So if you look at York's own ownership over Queen's and McGill, York clearly has direct control over both Queen's and McGill. But also if you look at the chain of ownership, Queen's owns 70% of Carlton. So Queen's controls Carlton, but because Queen's itself is controlled by York, York has indirect control over Carlton. And likewise for McGill, McGill owns 60% of the shares of Trent. So McGill controls Trent, but McGill is controlled by York. So York also has indirect control over Carlton and Trent, which means York has to consolidate all of these companies. So you first have to establish the chain of control. Secondly, you want to look at what the percentage ownership is. So York owns, as far as Queen's company is concerned, York owns 90% of Queen's. Now, as far as McGill goes, York directly owns 80%, and Queen's owns 10% of McGill. So because York owns 90% of Queen's, York owns 90% times 10, an additional 9% of McGill, giving it a total of 89% over McGill. And then given that Queen's owns 70% of Carlton and York owns 90% of Queen's, York owns 90% times 70%, 63% of Carlton. And then as far as Trent is concerned, McGill owns 60% of Trent, York owns 89% of McGill. So that works out to York owning 89% of 60%, 53.4% of Trent. We're told that for the year ended December 31st, year two, the separate company profits were 54,000 for York, 22,000 for Queen, 26,700 for McGill, $15,400 for Carlton, and $11,600 for Trent. And this is before adjusting for intercompany profits before taxes. The inventories were as follows. So York, as the selling company, had made a profit of $10,000 in the, well, this is basically unrealized ending inventory profits. So there's an unrealized ending inventory profit of $10,000 before taxes for York, $1,000 before taxes for McGill, and $2,400 before taxes for Carlton. The income tax rate is 40%. So guess what? We will need to subtract the unrealized intercompany profit. So 10,000 before tax gives us $6,000 after taxes because the tax rate is 40%. So York is the seller. You want to subtract $6,000 from York. When McGill is the seller, 1,000 before taxes gives us $600 after taxes. Subtract 600 from McGill's income. And Carlton's incomes take away 60% of 2,400. So that's a total adjustment of $8,040 due to intercompany unrealized profits, giving us adjusted profits, 48,000 for York, 22,000 for Queens, 26,100 for McGill, 13,960 for Carlton, 11,600 for Trent. The sum total of these adjusted net incomes, folks, is the total consolidated net income. Out of this total consolidated net income, 100% of York's share belongs to York. 90% of Queens is York's share. 89% of McGill is York's share. 63% of Carlton is York's share. And 53.4% of Trent is York's share. So if you calculate these amounts and then add them up, you get consolidated net income attributable to the parent company as being the sum of these 106,018. Since the consolidated net income total is 121,060, the consolidated net income that belongs to NCI is the difference, $15,642. So that was basically a look at the calculation of consolidated profit attributable to York shareholders, 106,018, and consolidated profit attributable to NCI, 15,642. Now, of course, you will be sort of wondering, oh my God, this doesn't seem like a proper consolidation problem. Yes, it doesn't have all the wonderful niceties about amortization of acquisition differential, etc. But here, we were just trying to demonstrate the idea of how you can have so many companies within a group and you can still calculate consolidated income, and you have to prepare consolidated financial statement. So that is all as far as this video is concerned. It was a longish video and it did cover a lot of topics. Thank you for watching to the bitter end. I will look forward to working with problems in class.